great to have you back on the show.
Morgan, thank you for hosting me this morning.
So let's talk about the results. You flat volumes, but you did report higher revenue. It really speaks to the pricing power you've been able to command at the railroad. How sustainable is that looking out into the coming months? Can you continue to raise prices if need be?
Yeah, Morgan, in addition to pricing power, it also showed the power of the overall franchise because there was a strong business mix effect as well. And that's supported by some of the business development activity that we've got underway. In terms of the pricing environment, it's a good environment, right? Truck capacity is tight. That's a great area for us to be able to compete in. And it looks like truck capacity is going to remain tight as we go into 2022 and maybe even beyond 2022.
Which speaks to some of the supply chain bottlenecks we've been seeing, the gridlock, some of the issues. I think about the ports, particularly on the West Coast, which I know you're picking up containers from to transport around the country right now. Just in terms of some of that congestion and the ripple effects, do you see that going into 2022 as well?
Yeah, I suspect so. Morgan, the fundamental issue, as you point out, is we need more capacity in truck driving and in warehouse and distribution centers to be able to handle this increased demand for goods being shipped into the United States. We've seen some progress there, but not enough yet. And that's fundamentally what we need to see. So that's all about labor. It's all about making sure we get the workforce kind of right, matching supply with demand. And I suspect that's going to happen. I just don't suspect it's going to happen this year. So it'll tail into next year.
Okay, and of course, precision scheduled railroading, which you've been implementing over the last couple of years, plays a big role in how you're able to navigate this, I would imagine. The lowered guidance, though, for full-year volumes to an increase of 5% from the prior guidance of 7%, does that speak to all the supply chain issues we're seeing?
Absolutely, it does. If you recall, coming into the year, our guidance was 4 to 6% volume growth. Coming out of the second quarter, the environment looked so good that we raised that to 7%. But then we continued to see disruption from semiconductors in the automotive industry, the international intermodal supply chain disruption, and as a result, we lowered it to 5% now.
Yeah, I want to get your thoughts on the industry more broadly, because we've seen a lot of activity over the last couple of months. And something I know you and I have spoken about before, but consolidation, you now have Kansas City Southern tied back up with Canadian Pacific. You've got the CSX Pan Am deal that is trying to move forward as well. And then, of course, changes in terms of leadership over at Canadian National, where you have activist investors that are looking to see a former UP executive, Jim Vena, helm that company as well. I guess your outlook for the potentially changing landscape and what it means for Union Pacific, since so much of the freight that you move gets handed off to some of these different railroads.
Yeah, you're exactly right. About 40% of our business is interchanged with another railroad. Either they originate it or they terminate it for us. And let's pick apart all the things you just talked about. You know, the CP purchasing the KCS, we've been very vocal about. We've got several concerns. The overriding concern is we want to make sure our customers continue to have good commercial access to and from business in Mexico. So we're involved in that process to make sure that that access remains. In terms of the transaction the CSX is trying to do, we look at that as a relatively minor transaction. I'm hoping they have success. It sounds like something that works for them and their network. And when our peer railroads, our partners in joint business development, are running a better network, have more opportunity, that generally creates more opportunity for us as well. And then in terms of just overall, we think our best reaction to what's going on in the rail industry is to continue to run an excellent railroad network. We have the best franchise in the industry. We have an excellent team. We're hitting on all cylinders. We've got some opportunity to create a little better service product and continue to recover from the impacts of the wildfires and some other events that occurred in the second quarter, or in the third quarter, excuse me. And we feel very good about that. So our future is very bright.